I think that one of the things that people should be aware of is just the operational pressure on these deals right now. I mean, we're seeing at every aspect on the pro forma, budgets are increasing, whether it's labor rates, utilities, taxes in many jurisdictions.
Welcome to BuzzHouse, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrick Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. This is an exciting episode because today we are recording from the Minnesota Affordable Housing Summit. And for those that aren't familiar with this event, the Affordable Housing Summit is an affordable housing conference located here in Minneapolis that focuses on the development and financing of multifamily projects. A lot of great topics are discussed on the conference side of things, including workforce housing, of course, not using tax credits, supportive housing, rent control, and many other topics. It brings together a wide variety of housing players, including developers, owners, management firms, the State Housing Finance Agency, among others. For today's episode, we are bringing you a series of short interviews with various show attendees to share some of the common themes, insights, and takeaways from this year's Minnesota Affordable Housing Summit. We are very excited to have Michael Lear join us in the BuzzHouse today at the Minnesota Affordable Housing Summit. Very exciting. Today is a record turnout for the conference. There are 490 some registered, plus some walk-ins as well. So very excited. Everyone's, of course, excited to get back, seeing people in person and so forth. And very excited to have Michael in person with us today. Michael is the Chief Business Development Officer at the Community Development Trust, or many of you know it as CDT. Michael, thank you very much for your time today and taking time out of your busy schedule here at the conference.
Sure, my pleasure.
Michael, for our listeners, would you maybe just start out giving a little background of yourself and also of CDT?
Sure. I'll start with CDT because it's more interesting than I am. CDT is a national investor in affordable housing. We've been around for 24 years, and we've invested over $2.7 billion to create and preserve affordable housing all over the country. We currently have activities in 45 states and territories, and we've either created or preserved affordable housing in well over 50,000 units at this point. So we've been around for a while. We have established products on the debt and equity side, and I'll talk a little bit about those to the extent you want me to. We elect to be taxed as a REIT, but I think more importantly, we're also a CDFI, and we're a member of the Federal Home Loan Bank of New York. And the key thing about our capital is that it is long-term and meaningfully so. So historically, we've always raised capital on and through our balance sheet. And as a result of that, we don't have, our money does not come with any sort of fixed term or required exits on a given time horizon. And we think that's meaningful and additive from a mission perspective, because we fundamentally believe that long-term capital is appropriate for affordable housing, providing stability of ownership and stability of an approach to making sure that those properties are always our problem and not the next person's problem.
Sure.
So we fundamentally believe that's mission additive, and it's a core element of who we are and what we do. As far as myself, I've been at CDT for 11 years. I came over from city government in New York. At that time, I've got a urban planning background and an engineering background, but I've never practiced a day doing any of that. I've only been on the affordable housing, either policy or finance side for my entire career so far.
Very good.
Mm-hmm.
No, thank you for that introduction, Michael. Michael, you touched on debt and equity products, some long-term. Could you maybe just kind of jump into what are some of those products?
Sure. So we have three business lines: multifamily debt, charter school lending, and equity investment. So on the multifamily debt side, we originate and purchase long-term perm debt on affordable housing projects. I would say most typically, historically, it's been in the form of forward committed perm loans on new construction tax credit deals. Historically, one of the impetus for us being formed was to create a secondary mortgage market when the banks didn't want to carry that stuff in the 90s and 2000s, especially small balance loans, because they're very low risk, and we evidenced that, building quite an impressive portfolio over time. But the banks didn't want to carry that stuff on their balance sheet, and they wanted to go churn their capital through and get to the next. So we did a ton of that work in the late 90s and throughout the 2000s. And I like to think that on the debt side, we helped to evidence the safety and security and low risk of those debt products. Very, very few, if any, negative outcomes on that end. And so now the GSEs do it direct in cash collateralized form, and the banks are happy to carry that stuff on their balance sheet because it's incredibly high quality credit. So that's on the debt side. We also, make long-term permanent loans on charter schools that are operated by high-performing, reputable organizations, and we're really cognizant when we look at those opportunities that we're partnering with a group that's affecting material change on the ground in the communities in which they operate. And on the equity side, which I manage, we make long-term equity investments in the creation and preservation of affordable housing. I'll say that a bunch of times, and also say the word long-term a bunch of times. We've not historically raised our capital through closed-end or term limited fund structures. And in the marketplace, this puts us in a unique position where we can make investments, and in many cases with the right kinds of partners, or particularly aligned partners, where we don't have to rely on near-term or medium-term, capital events to pencil out our deals. We're looking for cash flow. And as a REIT, we need to pay the dividend, keep the lights on, and frankly, grow the balance sheet through the assets over time, which allows us to raise more capital and do more of all of the above. So when we make an investment, we fundamentally want the capital event at the property level to come when the property needs it, not when the capital demands it. And so we can be flexible on that front. That puts us in particular alignment with long-term holders, organizations that have affinity for long-term control of their properties. So you could really kind of project that out and think, who does that match? It's public housing authorities, it's other state or government bodies. When they understand who we are, what we do, talk to other people that we've worked with, we're in a unique position to say, like, we've done this, and we talk to these other housing authorities where we don't force them to sell their properties. We don't try to take them over, and we also partner with very mission-centered operators and long-term, I think of them as like long-term kind of family-run businesses in affordable housing, where the long-term control of their assets is important to them, right, not the cycling through of their capital and other people's capitals through fund structures.
Very good. Very good. Very informative. Michael, just, these different products, I know the debt and the equity might be different answers. For our listeners who are many developers and owners, do they reach out, to CDT directly? Do you, maybe on the loans, or, they're intermediate? How do people access this capital? So
it's a little bit of both. On the debt side, our opportunities come to us either direct through repeat business, and really we offer incredibly high touch, responsive, flexible, debt executions in a way that, you're not going to get that from a bank. On the flip side of that, we're never going to be as inexpensive or as efficient in terms of a product space. And that's been the case, especially as the GSEs have played more of a role in the perm side. But we're also substantially more competitive in a higher interest rate environment, which, at least for the moment, appears we are or will be for some near future. And folks can reach out to us directly. A lot of the opportunities that we've looked at over the years have come through us through correspondent relationships, and we've also acquired portfolios from regional consortia that make these loans, and then they would like to cycle their capital through, and we can provide an exit for that, and a landing spot in a strong mission environment that's consistent with their original goals. And then on the equity side, it's really a bit of both, but the majority is pretty direct through myself and my team. I like to joke that my team really originates relationships, not deals. And, that's not surprising, I think, for anybody that is a limited partner. We're not out necessarily pounding the pavement to find the deals. We want to pound the pavement to find the right partners that we'll be super aligned with, so that when an execution comes up, they know we're there, we'll do it. And we never want to build a partnership to do one deal.
Right.
So almost all of our business is repeat, especially on the JV equity side. That's been true for my 11 years at CDT. And, it's far more efficient for us to find the right partners, and perhaps the right government partners, to make sure that everybody knows that when something comes up and it fits us in particular, that it really fits us, and we're fairly unique in the space. The only other thing I'd mention on that front is we do a lot of recapitalization with with organizations, nonprofit and for-profit, that don't want capital in their deals, that will kick them out and take over. That behavior is not in our makeup, our DNA, our management, our board, and it's certainly inconsistent with our ethos. And we have a track record that when there's a problem, we all sit down and figure it out. We don't just go to the documents.
Sure.
And we also always look to ensure that when it's time for CDT to exit an investment, and that almost always comes at the request of our partners and not from CDT's perspective, we always want to make sure that we're facilitating transitioning individual property investments and properties to their next phase as affordable housing. We never take to market, we never do qualified contracts, anything like that. And we also never squeeze our residents at the end in order to get an extra buck at a capital event.
Got it. Michael, I know you touched on earlier, right? I think I wrote down 50,000 units of preserved housing. So obviously it's a big component. And I know you're doing loans probably. What's kind of like, you said it's a blend, some new construction. I know maybe we'll talk in a question or two on workforce and things like that. So is equity, are you able to use the equity on preservation and new construction, or how's that look?
We are. The bulk will almost always be, because we're a REIT and we have a dividend to pay on a regular basis, we will never be out with all of our balance sheet capital in deals that don't cash flow. And it's just a function of our structure. But to answer your question, yes, and we do look at new construction opportunities. As I mentioned, this will never be the bulk of what we do given the dividend requirement of our capital structure. And there's no early term cash flow unless you create it through some sort of reserve, which is just smoke and mirrors at the end of the day. In terms of building things from the ground up, I'm sure many of your clients are dealing with the market dynamic right now. If you had a pro forma that worked in the first quarter of 2022 on a new construction deal, it no longer works.
Right.
And it needs, so either risk needs to shift in particular directions, or a tear down and build up of your capital stack needs to deal with the forward debt if there's a commitment on the forward debt side. And so at this moment in time, we're trying to figure out how to proceed on a number of potential opportunities that fit that profile, just like everybody else in the world in this volatile environment. And I'll get back to you when we figure it out.
We'll wait for that the silver bullet. And maybe, this question, maybe we can kind of get through quickly, but it's just that it's higher, interest rates. We all know costs are up, even if someone's doing rehab and so forth. We're all working it together, I guess, right? Government funds.
It's just math, right?
Just math, city funds, things like that.
Yeah, when the volatility comes from the lowest risk, position in the capital stack, there's nothing else anyone else can do about it other than try to figure it out. You try not to value engineer in a way that makes your product less than what you need it to be from a reputational standpoint and from a resident outcome perspective. But, it's like I was saying before, you don't complain about it. You sit down at a table together and see if there's a way to figure it out and kind of, share that burden in order to move these things forward, because they need to be moved forward.
Absolutely. Michael, maybe just one last question for you. I know you're on a panel today. I think the panel is entitled Developing Workforce Housing Without Tax Credits. Any other items we haven't hit today that you would like to get out there on any kind of topic?
I would say, as far as when we think about workforce, and I'm going to say this on the panel in a couple minutes, is we think about it in a very kind of structured way. Because we're long-term capital and because we want to transition properties to, I would say, better and better and deeper affordability trajectories in their lives. When we're acquiring workforce housing, we're typically buying things that are, let's call it 60 to 100% of AMI. We're partnering with strong owner operators that have the ability to operate something different than a tax credit property in a different capital environment than within a tax credit structure. And so what we always look for is there replicable and scalable subsidy tools available that can move quickly, right? That's a core challenge from an acquisition side, but also from a de-risking position from our position, from our equity position. We always make sure that we record the affordability, not in a partnership agreement, because that's only as good as how
Sure.
You only have yourself to look to in that one, and things change. And so when we invest in workforce, we record new regulatory agreements and whatnot, and they run beyond us. If our capital needs to exit at some point, they don't rely on us to stick around to do that, which we think is the real kind of value out of this stuff. And we're very sensitive to when we're acquiring these properties, which A, tend to be older, and B, tend to be in less great shape, and we're really competing with value add buyers. In many cases, we need to adequately capitalize those properties, and we need to do it upfront. So that limits, on one hand, the kind of pool of things that we can execute, and especially in different geographies that may or may not have subsidy tools that fit what we need, but we don't like to get hung out in market changes. You know, we experienced some of this in the early 2000s, mid 2000s, where you wind up having to make decisions that you don't want to make. And as a mission owner, operator, and investor, you know, we're super sensitive to that, and we want to make sure that what we do is set up for success, not set up to push that risk of a lack of success onto the residents at the end of the day.
Right.
So we're very, very sensitive as to how we go into these things, and what's locked up and what isn't locked up, and how are we dealing with that kind of risk, and not just shifting that risk onto residents at the end of the day.
Very good. Michael, a lot of really good information for our listeners to hear. Really appreciate you taking time for the conference, and hope your panel goes well today as well.
Thank you so much.
Thank
Appreciate it. Thanks, Tom.
We are very excited to have Mike Rossi join us today in the BuzzHouse here again at the Minnesota Affordable Housing Summit. As I mentioned earlier, it's a record-setting year for attendance and registrations at the conference. I think a lot of people just excited, like Mike and I talking now, just getting together. What's new? Haven't seen you for a year or two in person, so really excited. Mike is a senior director for housing credit investments at Enterprise. Mike, thanks very much, honestly, for taking your time out of the conference and speaking with us today. Mike, just starting out for our listeners, would you be able to give a little background about yourself and actually then Enterprise as well?
Sure. Thanks, Tom. It's good to be in the BuzzHouse. My name is Mike Rossi. I have been with Enterprise for 12 years. I've been with the credit investment side the entire time. Began as an analyst out of business school, spent some time underwriting, and I've been in the originations role for about 3 years now, just slightly preceded the pandemic. So it's great to be out and seeing people again in person. And Enterprise is a national nonprofit organization focused on housing. We have a variety of resources available for those in the housing sector. We have a capital platform, which is the group I work with. And under that capital platform, we have our equity syndication group. We have Bellwether Enterprise, which is a lender with Freddie, Fannie licenses, FHA. They also do market rate as well, private placement, so full service lender. We have a CDFI, and then within other divisions of Enterprise, our solutions division, we have consulting, we do Section 4 grants, we have a very large public policy initiative within our organization. We work at the federal level and in various states. We have, I think, about a dozen offices around the country where we work on local policy initiatives and work with our local nonprofits to expand their capacity and expand the access to affordable housing.
Well, good. Thank you for everything that Enterprise does, obviously, for our industry, such a big player in the industry. So, like, just kind of starting out, maybe it's almost like an underwriting type question. And obviously, the last 2 years have just been, its own 2 years, right? And again, construction costs aren't stopping, and interest rates are rising. We really focus on, supply chain and construction costs. I mean, are you looking at, contingency or construction contract? What are you focusing on? Is there anything different, or is it just really the same, but just how are you looking at this and rising costs?
Well, I think that historically our industry is always experiencing, it seems like, an existential crisis here or there. And over the past few years, it's been more routine that we're having to do additional underwriting analysis and stress tests around all aspects of a project. And I think that when we're looking at projects now, trying to overcome the issues around interest rates and construction costs and extended construction delivery schedules, we're looking at sponsorship. We really want to understand the sponsor's business model. We want to understand reliability of their cash flow. We want to understand where their deals are in their process, how reliable their development fees are going to be coming in. We want to know what the impact's going to be if a grant doesn't come through. I mean, is it a bet the farm kind of a situation with the sponsor, or do they have the capacity to withstand the hit? So sponsorship is a very critical aspect of underwriting at this point, even more so than usual. On the construction side, we want to understand, have these development team members worked with each other before? Do they have a rapport? Do they have an ongoing relationship that makes sure that the GC is going to pay attention to this developer? Does the GP have deep relationship, or the GC have deep relationships in the market with the subcontractors? We want to see, I think, understand what happens if there's construction delays. We run some stress tests around what happens if there's a 6-month delay, both on how that's going to be impacting project costs in terms of interest carry and then also lease up, credit delivery, all those things. We want to understand how the deal itself can withstand those hits, and then how the sponsor and guarantor might be able to as well. On the subcontractor side, we're doing additional analysis around buyouts. I think right before closing, we want to see 60% of the contracts bought out. If that's not the case, we're going to want to understand what the risk mitigation aspect is. Like, how are we going to manage it? If one sub that's not bought out comes in much higher than what we had expected, what's going to be the impact on the deal? And then as far as interest rates, as those continue to climb, we just heard about the Fed's increase yesterday. I think that our baseline is now a 50 basis point cushion to the quoted spread. That's higher than what it used to be, where we used to be 25 or 30. And now we're looking at in the second half of the construction period, we want to assume what happens. We want to understand what happens, assuming another 50 basis point increase. And then for bigger projects with longer construction periods, we do additional analysis. So we're sizing the interest reserve appropriately. And yeah, there's a lot of headwinds, a lot of challenges. Yeah. So those are some of the things that our investors are asking about. We're responding with additional analysis to be able to answer those questions.
No, good. Thanks, Mike. That was really good for our listeners to kind of hear about and think about as they're putting their deals together right now. So kind of on a, somewhat related topic with interest and, everyone's, inflation and where's that at? And, at the macro level, Mike, what's that effect on the local housing tax credit equity market?
Sure. Well, I guess it's anybody's guess, but I think that, historically, if rates are rising, then the risk-free, we're going to want to see the usual spread over the risk-free rate. So you're going to see pressure, upward yields is going to put pressure on pricing. I think that, we're raising 3 national multi-funds this year. And at this point, we're assuming that there's really not a big spread between our earlier in the year funds and our later in the year funds. Pricing's pretty similar, but I think that it's an interesting dynamic. We're able to attract some additional investors into the market now at these higher yields, but also deals need strong pricing to get closed. So where's that economic money? Where's it going to go? We're having it's a challenge finding deals that can close at the economic pricing, which is 85, 86 cents. So that's a dynamic that we're seeing play out. I think that the CRA demand continues to be strong. A lot of banks are going to be starting a new cycle in 23, so we'll see what happens with that. But I think it's going to be, it's a good product. Everyone's aware that it's especially on a risk-adjusted basis, it's a strong investment. Yep. So I think it's going to continue to be attractive. But how we're finding those economic price deals, and I think that is part of it that is going to be a continuing question going forward.
Yeah, no, that's very fair. Exactly. Mike, switching gears a little bit, later today at the conference, there's a panel entitled Intentional Steps Towards Equitable Access and Real Estate Development. And Mike, you and I have had a chance over the last number of months to talk about similar topics and so forth. Could you let our listeners know a little bit about what the work Enterprise is doing around the space with underrepresented developers?
Sure. So Enterprise at the organizational level has our Equitable Path Forward initiative, and that's a nationwide initiative. The goal is to deploy about $3.5 billion in capital around this initiative. Wow. And then within each of our capital entities, we have our own programs around this. So where I'm participating in this within the syndication group is around identifying developers who are active in the market, have some real estate experience, and particularly some LIHTC experience, who maybe historically have had to partner with entities that have deeper balance sheets, and then as a result don't get to benefit from the risk they're taking on and the work they're putting in, that those economics are going to their partner. So Enterprise has been stepping in within our equity group, and what we have is called a standby guarantee facility. And that standby guarantee facility is basically a line of credit that we offer to the guarantor. It's not to the deal, it's to the guarantor. And it's unsecured by the real estate. So it's just personally guaranteed basically by the guarantor. And what we do is we provide a line of credit up to the amount of liquidity that a typical institutional investor or lender would want to see, which is around $1 million. Yep. So we've deployed that on a few deals so far. We've closed 2 of those projects. I think a third is closing this week. And the goal is that so that these developers who have this LIHTC experience and we know are going to operate the project, well that they can benefit from the economic upside of the project and become a kind of a self-sustaining organization, not have to partner in the future. So it's having the desired effect on the deals we've done so far.
That's very exciting. That's very exciting, Mike. And deals are closing with this.
Yeah.
It's kind of very neat to see.
Yep.
Like, just one last question, while we have you here. Just, I mean, really, I know you're on the equity panel here at the conference. Any other kind of general topics that you might be hitting on the panel, or would you like to let our listeners know about?
Sure. I think on the panel later today, we'll be probably talking about pricing, and that's the usual equity panel discussion. I think we'll probably be hitting on some of the underwriting issues that we've spoken about. I think that one of the things that that people should be aware of is just the operational pressure on these deals right now. I mean, we're seeing at every aspect on the pro forma budgets are increasing, whether it's labor rates, utilities, taxes in many jurisdictions. And although it's a small line item in the overall budget, insurance is becoming a bigger portion of the overall
Sure.
budget, and insurers are dropping out of the market. And it's harder to have policies that comply with investor guidelines. So we're seeing a lot more waiver requests for higher deductibles. Bigger developers are employing some strategies to deal with this, but it's hard for small developers. So I think it's a challenging time, especially as the industry tries to incent new developers to come into the marketplace. How to set them up for success. That's something that we really have to be aware of. I think that LIHTC investment and development is not a get-rich-quick scheme. You can definitely lose a lot of money on your first deal, but you're not going to get rich on your first deal. So this is a long-term play. We're talking about supporting organizations that are in their communities, and we want to see growth and financial growth within those communities. And it's, LIHTC can be catalytic in those communities, but it's not the only piece of the puzzle.
Yeah.
So we have to be thinking long-term and how to support these groups and the communities in which they develop.
Very good and great advice. And again, Mike, always a pleasure talking to you. Thank you for joining us on the podcast today.
Yeah, thanks, Don. I really enjoyed it.
Thank you for listening to BuzzHouse. To receive a notification when new episodes are available, please subscribe to BuzzHouse, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.